Hello everyone, I'm Michael Lytle, Chief Investment Officer for StoneX Wealth Management. Today we wanted to look at technology stocks. This keeps coming up in the news and trying to draw parallels to the past and the present, and so we wanted to give you our thoughts and maybe a few different ways to look at this. So as you see a few things on the screen, we'll describe them as they come. The first thing you'll see are returns. So this is sector performance in two periods. The first one on the left there, you see in the shaded box. No conclusion to draw other than just trying to help you separate the lines on the page. So the left one starts 1998, runs through the end of March in 2000. And so in 1998, if you remember, kind of the August-September timeframe was a pretty difficult period. So we had the Russian default on the ruble, concurrent with just general unease and kind of malaise, if you will, in the emerging markets. There was this little hedge fund called Long-Term Capital Management that was extremely highly levered in some of these very same markets and had to sell to kind of unwind that leverage as things were going down. And it just really caused kind of a cascade of events, a real difficult time in August and September. That began to change in early October, and technology stocks took off and really never looked back, to the tune of 250% before that bubble burst in late March of 2000. So we now move to the middle, which is the dark shaded period here. And this is really beginning in kind of late 2022. So similar kind of setup with challenges in the markets. This time it was inflation. As you remember, huge spike in inflation that year, kind of peaked out mid to late summer and began to, I won't say go down, it really began to go up less fast. And that's what kind of changed sentiment, and technology stocks again took off. Not quite as abruptly or as quickly as the prior period, but still substantial outperformance over this period. You see 160% there on the chart. That was through the end of August, so the past couple of days notwithstanding. But point remains, large performance here. So what are a couple of fundamental things that we can look at to compare these periods? So we start with cash. So on the left here, you'll see in blue, cash and marketable securities. So the far left are the top 10 technology companies in that 2000 period, and we'll cover the names in just a second. You see, kind of high 60s in terms of 60, some odd $1 billion in cash added up. So the combined cash of all 10 of those companies. If we adjust that for inflation over the last 25 years, CPI is up kind of in the low 90s. You end up with just shy of 130 billion in cash. Today, 580. So significantly more on balance sheet cash today, even after you adjust for inflation, than there was 20, 25 years ago in the top 10 names. Let's move to the right and look at valuations. We see price earnings ratios. And honestly, both of these are just crazy. So 80, almost 82 back in March of 2000. We're at 61 right now. So a couple of things to kind of note about this. One, across both periods, expectations are just astronomically high. You don't have an 81 or a 61 PE if expectations aren't just crazy high. That said, there are more reasonable expectations today relative to 2020. So again, we're talking relatively speaking. And I think that's because of the E. So the lower PE today is because earnings are higher and producing more cash, which is that giant blue bar you see kind of in the middle of the page, than we were back in 2000. And those that have been around kind of remember the fundamental challenges of that period. Prices ran and the businesses really couldn't justify it, and no one really cared until they did, and then the bubble burst. So at least at this point, there's more cash generation happening, and that's showing up both in a lower PE, relatively speaking, and higher levels of cash. That said, 61 is still just a really high number, so I think that's worth noting and making sure I don't gloss over that and give you the wrong impression. This is the part that I think is really interesting. So as we move forward, we'll look at the top 10 names in 2000. You see those down the left-hand side there. For those that have been around in the markets for a while, there's going to be some nostalgia as you look at some of those names. And we move to today. And so we won't make you draw your finger back and forth to see who's still there. We'll lay all that out for you in a second. But first, let's throw a couple of brackets around it. And so the names you see are the top 10 technology names. The brackets are around the top 10 names in the index. So you see in March of 2000, Cisco, Microsoft, and Intel were also top 10 S&P names, as well as within the top 10 of their sector, obviously. Today, you see there's 8. So one note, Google here, we've combined both alphabet share classes into the same one, just to make the example a little simpler. But the fact remains, 8 of the top 10 names are in the top 10 names of the overall index, as well as just the S&P 500 broadly. So big changes over the last 25 years. So let's cover a few of those. First, we'll cover those that just dropped out. So Cisco, Intel, IBM, HP, all are no longer top 10 names in either the index or their sector. Didn't grow as fast. Other things grew faster. Whatever the case may be, they're just not in that top 10 anymore. Interestingly, both Cisco and Intel were in both top 10s and are no longer in either. So I think that's instructive as we kind of keep talking here. Additionally, 4 more had major kind of organizational changes. So Sun Micro was bought by Oracle. Dell went private, spent a few years that way, then came back public, kind of in a unique story that you can look up on your own if you're interested. But during that private time, also bought EMC. So they are out as well. Lucent merged, and then that combined company was bought by someone else as well, by a third company. So really we're left with Microsoft and Oracle as the only ones that either maintained their corporate identity or stayed in the top 10 over the last 25 years. And you see Oracle kind of hanging on to the end of that, to be honest. So let's look at some characteristics here, and I'll focus on Microsoft, and because I think that's instructive again as we look forward. So if you look at March of 2000, Microsoft had the largest cash balance of any of the top 10 companies on that list, and it really wasn't close. So if we just say, hey, let's look at today, and is there something we can learn from that? Those names today are Apple with the largest, and then really Microsoft, Amazon, and Google all have a pretty similar number, really high for what it's worth. And so if you take those 4, the break between them and number 5 is pretty substantial. So we look at high cash balances, you look at those businesses, and a lot of them have kind of a recurring revenue kind of basis to their business. They may have not always been that way, but they've kind of evolved into that. And that's frankly how they're generating cash and how they're kind of evolving into what we want to see going forward. So, don't take any kind of firm recommendation in that. I'm really just kind of identifying characteristics and using these 4 names as examples. What I think you can feel reasonably certain about is it is highly unlikely that list of today's top 10 will be the same 5, 10, 15, 20 years from now. It rarely is over any period of time. So let's look for those underlying characteristics that tend to persist, that allow companies to maintain that leadership and evolve and go through different markets. I mean, think about the last 25 years. So that list on the left had to endure the dot-com bust immediately thereafter this, the global financial crisis, and COVID. So some significant major market and economic events that happened over that period, which is why we kind of pointed back to cash. So it's a ballast during difficult times or business transitions, but it can also be a strategic advantage to go buy that other business or start a new line. Think of Amazon using their kind of sales business to fund Amazon Web Services, which is now a material part of their revenue. So doing things like that are the kind of things that allow names to persist over time. And those are the kind of things you're going to want to look for as you look at this list and you look at others to see what will persist for the next 5 or 10 years. So with that, thank you for taking time and spending it with us today.